Right, start the recording. And yes, thank you. My name is Jamal Khan, and I'm a senior tax partner at Churchill Tax. Thank you for joining today's session. We do try to hold these sessions once a month, and we normally get large crowds attending. Today's topic is about bad tax schemes and tax avoidance schemes. It's a very interesting topic. I get approached every day almost with people who've been to various tax advisors, or not tax advisors, but people who sell tax schemes. And they ask me, Jamal, is this valid, or what's your second opinion, to get a second opinion? And so I have a few easy tests, and I thought I'd talk about those, and then we'll go through a couple of case studies, examples. So if you have any questions, please put them in the chat box. I would love to be able to answer them. Right, let's get started. So I'm going to share my screen. Just 1 second if I can. I hope you can now see my screen. And here we are. Right. Okay. So bad tax schemes and how to spot them. This is a little bit about us. And so we specialize in tax advice, tax investigations, tax dispute resolution, but a lot of we do a lot of tax planning. I'm a chartered tax advisor, and I have been in practice about 27 years, and I've advised many clients. I have seen numerous tax planning strategies or tax avoidance schemes come in and go over the years, and I have a very simple policy of staying safe, staying on the safe side of the law. Right, so what's the tax mitigation strategy? So we need to, first of all, distinguish between tax mitigation strategies or tax planning strategies and tax avoidance schemes. So tax mitigation strategies are those that where the UK tax legislation allows numerous reliefs and exemptions. And the legislation is quite complex. And that's where the fine line is very sometimes difficult to see. But how do you spot things like that? First of all, it is for the taxpayer to seek specialist advice from a qualified person. And usually, if it's not a qualified person, then you should be very careful. Somebody who's known as a tax advisor. So yes, you speak to a specialist tax advisor, and it's for the taxpayer to avail the reliefs and exemptions. So so some people have a policy: I will pay £200 to my accountant, and my accountant will advise me what to do. But the accountant is not equipped to give advice. He's not trained to give advice. So this can be very. Sometimes I've seen clients who have not been able to claim some very important reliefs over the years, and they've lost money. So it's better it's worthwhile to invest in a good tax advisor, and because the tax that you save is a lot more than the money that you pay to the tax advisor. And once you claim the reliefs and the exemptions, this is tax planning. Tax planning is our legal right. This is what Winston Churchill said. That this is our right. You'd be foolish not to claim their exemptions. It's our choice if we want to. HMRC, when you ask HMRC for tax advice, they will ask you to go and see a tax specialist or a tax advisor to help you with tax planning. Now, what are good tax planning schemes or planning strategies, should we say, or tax mitigation strategies? So the pillars of good tax mitigation strategies, first of all, is if it's a genuine tax mitigation strategy, it's not too good to be true. It's not easy. It takes a good planning strategy takes time. It's not an overnight solution. Sometimes people would come to me, Jamal, I need this done, and I need this done in a month, or I need this done in a week. And I would say, no, it's not possible, because if you're going to follow the rules of HMRC and the legislation, there's no immediate results available at all. So this can take some good time. Good tax planning strategies can take years. And whenever I put together strategies for my clients, it can take many years to come into full force. The results take a long time. They are very bespoke. So the tax advisor will talk to you, consider your circumstances, and try and apply various strategies. And they're tailored, essentially. They're not marketed openly. And then for each client, there is a specific set of fees that are charged based on their circumstances. So these are good. These are kind of something, when you see something, it's not overnight. The result is going to take many years. It's not so appealing to the eyes, but at least it complies with the legislation. Okay, the end result is good. So it's not immediate, but the end result is good. Anything that's immediate is not always good. How to spot bad or aggressive tax avoidance schemes. And this is why we're having this webinar today. There are lots of them out there. HMRC have introduced DOTAS, disclosure of tax avoidance schemes, legislation, where promoters are required to disclose this to HMRC. HMRC then give them a tax reference number, and the taxpayer has the promoter has to give it to their clients, and the clients have to disclose it in the tax return. So there is a legislation behind this, and to counter this. However, there are some advisors, and I'm not going to name anybody in this event, this webinar today, but you will hopefully understand who I'm talking about. Or if you don't, you can go to taxpolicy.org. Okay, that's nothing to do with Churchill Tax, and nothing to do with us. It's available, it's public information. You can go to taxpolicy.org and you will see. Okay. So there are quite a few promoters that find ways to avoid DOTAS. Okay, they find ways to avoid DOTAS, but ultimately it is a DOTAS scheme because it's heavily marketed. So how do you spot an aggressive tax avoidance scheme that's likely to fail? First of all, it's very quick to implement. It's very convenient. Okay, it can be done within a couple of weeks or 2 months, a month or 2 months, and it's very easy. The arrangements are so artificial that we will do. I'll give you an example when we'll do a couple of case studies. I'll give you an example. One solution fits all. Yeah, so they've got a scheme, they promote it, and then they start advertising it, and anybody that it will eventually, ultimately, it will stick to anybody, right? One solution fits all, designed to be used by large numbers, so it's not just for bespoke at all. It's just anybody who has a company or anybody who has a property, you come by the dozens and sold by the dozens. Usually these promoters carry a QC or a barrister opinion to make it look authentic, or they would normally attach themselves to a barrister. Okay, once again, those who know what I'm talking about will know exactly who this is. So they will attach themselves to a barrister to make it look authentic, but they're normally have no history about tax advice. And they suddenly come up with a scheme and they try to make as much buck as possible. Usually should be registered, but yes, as a doge house, but they're there. Some of them still escape. Now, let me give you a couple of case studies. Artificial or fake director loan accounts. This is currently being marketed quite heavily, and I get to see lots of clients that come to me. Jamal, you know that company that's selling all these schemes? Once again, please go to taxpolicy.org to see what I'm talking about. So they will market various strategies. Anyway, so this is one of the strategies or schemes that's being sold is artificial director loan accounts. So what they're doing is they would say, you have a property, you form a property partnership or an LLP, and they would use the word to incorporate into a smart company. Okay, there's nothing called a smart company, by the way. A company is a company. Then you take before you incorporate, the landlord would take a bridging loan in the LLP's name or the partnership's name of say £450,000. And you would then the bridging loan would be taken over, would stay with the solicitors, and the solicitors would be the lender would have a covenant that this bridging loan is going to the solicitor, it will not be released to the company or the landlord. Anyway, so they would incorporate or transfer the properties into the smart limited company with the director's loan of 1 billion. That should be there's a typing error there. Let me see if I can fix that. That should be just 1 second. Let me just fix that for you so that you get the full picture correctly. Right, let's share it again. So you can hopefully see my screen again. Right, so you'll incorporate you'll incorporate with a £450,000 director's loan account. The £450,000 is part of the loan that the director would issue to the company at the time of incorporation. So when the company starts to make profits, the company can pay back to the director the £450,000. Although that £450,000 stayed with the solicitors, it never left the solicitor's account, it never entered the company, but it was somehow manipulated into the incorporation process. For those who know what I'm talking about, in incorporation, you transfer the properties into a limited company. So this was somehow manipulated into the incorporation process, and there's an artificial director's loan account. So, which is then paid back to the lender after a month or so later. But the director is now entitled to receive £450,000 tax-free from the limited company. And suddenly there's no tax to pay. And this is amazing. How nice is that? How convenient. And the director now gets to pay no tax, but in reality, if done properly, if everything is done correctly, there should have been tax on the £450,000 of roughly around about £150,000 of income tax to be paid. Okay, and there's also £140,000 of capital gains tax, because there are some tests and requirements of incorporation relief that all the assets must be transferred, but that money is never transferred. The bridging loan that is taken and kept with the solicitor is never actually transferred into the limited company. So that means the incorporation does not qualify. So there would be capital gains tax to pay as well. This scheme is being marketed quite heavily, and this avoidance scheme, and it's being sold by the dozens, and it will fail. It says very clearly on the taxpolicy.org as well that this is going to fail, and it should have been a DOTAS scheme. It hasn't been notified to HMRC as a DOTAS scheme. HMRC will prosecute the promoter, and they'll probably fine for £1 million sooner or later. Okay. The second one, that case study 2 that I'm going to talk about, is a fake incorporation, or incorporation, which is essentially means that you transfer properties into a limited company, and then you claim relief, and there's no capital gains tax to pay, and the properties are the mortgage interest that can be claimed. So we've got quite a lot of landlords at the moment that are going through a very bad dilemma. They don't get tax relief on the mortgage interest. They don't know what to do. In the companies, you can get full tax relief on the mortgage interest. They can't transfer their mortgages, so they've got a problem. So this promoter that's promoting them, they've come up with a very clever solution that actually doesn't work. So what they would say is that you sell properties to a limited company, you incorporate once you've had the properties for a couple of years, and there's a partnership and LLP. Anyway, so we'll skip all that. We'll come to the final product. So you sell the properties to a limited company, but you exchange, but you don't complete. But there is no, at the same time, there's no transfer of property to the limited company on land registry. The lenders are not notified. Everything is done through a trust that's created, in which the lender is the settlor and the company is the beneficiary. Right? So what's happening now is that the landlord would the company would be receiving the rental income. Okay. And the company would pay the rental income to the landlord, because the landlord is holding it on trust for the limited company. So the landlord would then pay the bank. The bank has not been notified that everything's gone to the company. And because there's a separate legal entity involved, the bank normally requires that there have to be this part of this condition of the lenders have to be notified. So landlord pays the bank, and the company pays the landlord, or the company pays the landlord. Landlord pays the bank, and landlord this way gets the full tax relief, because he's receiving. He gets full tax credit. So for him, whatever he receives is offset by the money that comes from the company, and essentially the company gets full tax relief as well. So the dilemma that people are having at the moment is they don't where the landlord currently or don't get full tax relief because of Section 24, that somehow goes away. Okay. So now what's happening is that there is no change of ownership. There's no notification to HMRC. There's no notification to the bank. There's no notification to land registry, and the landlord, nothing has changed. But now suddenly there's no Section 24 anymore. So this will definitely fail. Once again, this is also mentioned on taxpolicy.org if you want to see how this works. Third case study, which I've been asked a few times by some of my clients, because once again it's marketed quite heavily. This is where dividends are issued to pay for children's school fees, the private school fees, or whatever the expenses are. So, for example, a husband and wife, they have 2 children, and they were running a limited company that makes some profits. But if you refer back to my last webinar, parents cannot use their children and children under the age of 18. So parents cannot pass their income on to the children. So parents cannot give shares to, for example, children if they're under the age of 18. So for example, somebody's got children age 8 or 10 or something, they cannot pass on their income to their children. So somebody came up with really clever ideas that what they will do is in the limited company, the limited company will issue shares to the grandparents. And the grandparents will then pass on their income from the shares to the children. Initially, the grandparents had nothing to do with the limited company, but to facilitate this tax strategy or tax avoidance scheme, they will suddenly be brought in and given shares in the limited company, and they will be suddenly but they don't take the income; they pass it on to their children, to the grandchildren, and the children. This is how they escape the direct from parent to children route. But because this is artificial, the grandparents have no involvement in the company from beginning. Therefore, HMRC have already issued a statement about this, and they would block this. Okay, and they're pursuing people who have used this. But if it was on the contrary, if it was the company that was set up by the grandparents originally, and now they're trying to bring the children in, or they're giving the shares to the children, or somehow, so that would be seen as that's fine. I mean, if it's coming from the grandparents, that's absolutely fine. So this has been stopped by HMRC. Anyway, let's move on. This is me. If you've got any questions, you can contact me. This is what I do for a living, and my passion is to be the best at tax planning. If you've got any questions, you can send me an email. I'd be more than happy to help. And yeah, I'll see you hopefully in a month's time with my next webinar. Okay, thanks a lot. Bye.